Okay, all right, Ruchit. Thanks very much for that. So that's the call coming in on the technicals. But let's move on then. Last week's Indigo transaction is being viewed as a very strong example as to why exactly India's block deal mechanisms and rules may need an overhaul. This has reignited the debate for changing the block deal regulations. CNBC-TV18 spoke to a cross-section of stakeholders participating in such deals for their feedback. Vivek Iyer is here with the details on this.
Well, in the recent Indigo transaction, the institutional investors who were lined up by the investment bankers did not receive any allocation, as 100% slippage is said to have occurred in this particular deal. The Indigo case isn't really an isolated case as far as large trades are concerned, as per our dealer sources, some of the recent block deals like IIFL, Max Healthcare, Rolex Links, all have said to have faced a certain high level of slippage. In fact, a certain level of slippage is actually and usually factored in by deal brokers. Let's do a deep dive into how India's block deal mechanism actually works and how the regulator has set the guidelines, keeping in mind the interests of all sections of the market. Now, when the next graphic actually shows two designated special windows that are allowed during the day for block deals with restricted and predefined price ranges that allows just for 1% variation. Now, this is mainly done to ensure retail investors are not at a disadvantage and no foul play occurs. Now, when you're talking about a transaction like the Indigo trade, which is priced at greater than a 1% price variation, this typically happens on screen, and this actually happens outside the block deal window, leading to a possibility of a slippage. So then how exactly do slippages occur? Now, regulation ensures that no single order greater than 10 crore can be punched in during market hours. So a 300 crore deal would typically be sliced into 30 similar orders, and this occurs both at the buy as well as the sell side. Now, this typically allows informed market participants and sophisticated algos to put in their trade above the pre-decided deal price, and the 10 crore order limit is also aimed mainly at eliminating fraud as well as fat finger incidents that may cause large dips as well as large spikes either way in the stock price. But however, let's have a look at some of the other markets and how exactly they do facilitate block deals and where India is lagging behind. When you're talking about Australia, there is no real restriction that has been placed as far as the price is concerned, while Singapore, the deal states that the deal should only be done at a fair market value. Japan, in fact, allows for a much wider price variation, a plus to minus 7% variation from the previous day's closing price. Now, brokers in India have in the past and for a long time made presentations to SEBI and representations to actually go ahead and ease the regulations. They say typically slippages occur not due to retail investor participation that is capped up to 2 lakhs, rather by much larger, well-informed HNIs and ultra HNIs who take advantage of the on-screen variations as far as price is concerned. Some of the suggestions made by brokers include having a separate block deal window and allowing for order matching, which they believe will go a long way in solving this particular issue of slippages that are typically seen in large transactions.
All right, take that point. Interesting analysis out there, Vivek. Thank you so much for bringing us up to speed with the slippages that take place in the block trade and specifically telling us about the regulations in other countries as well. With that, we'll step into a short break. On the other side, excerpts from our exclusive conversation with JP Morgan's think tank. We had Sanjay Mukim, Madhav Kalyan and Sajid Chinoy.